Good afternoon, fellow debt slayers. Today we're going to talk about credit card interest rates. My name is Stephen Gallagher and I am a trained certified Dave Ramsey debt coach. My company name is Debt Free Results and I help people like you focus on their debt and build a plan on how to get out of debt. So today I got a pre-approved credit line card in the mail, and I know I've done other videos on interest rates and credit cards and such, but I wanted to go into a little bit of detail on this because these interest rates that they're proposing, and they're just sending out so many of these applications to everybody, the interest rates are unreal. This one starts at 29.99% annually. So I'm going to just round it up to 30%. And I think that is, I don't know, it's a lot of money. It's a lot of interest. And on one of my previous videos, I had talked about how 78% of Americans are living paycheck to paycheck because of credit card bills and because of the cost of everything, that these interest rates are just, people are never going to get ahead with interest rates like this. So I wanted to make another video and talk about interest rates on credit cards. And before we do that, I'm going to ask if you could take a moment, follow us and like us on this page below. The only way that I can help people is to get the word out about information like this. And if you know anybody who has debt issues or if they have credit card issues, please forward them over to me. I'll be more than happy to help them any way that I can, and have them visit our website at www.debtfreeresults.com. So today I received, like I said, this application. It's pre-approved for $4,000, which I don't need, but so I got this application in the mail, and it's like I said, it's pre-approved for $4,000 at an interest rate of 29.99%. So I wanted to go and show you or talk to you about how they charge us for interest on credit cards. And one of my clients, I had a meeting with them last week and we were talking about interest rates, and I went through a lot of what I'm going to talk to you today about, and how this is really rigged for the benefit of the banks and it's not in the benefit of the consumer. So I got this off of the Chase Bank website. And it said, how do credit card interests work? And if you carry a balance on your credit card, the credit card company multiplies each day by a daily interest rate and adds that to your bill every day. So the daily rate for your annual interest rate, or your APR, you would take your APR and divide that by 365 days, and that would give you your DPR, which is your daily periodic rate. I know it's confusing, but if you think about it and what I'm about to say and how they do this, you'll see how the DPR and the APR work. So in this case, I would take the 29.99% and divide that by 365. Or in this case, I'm going to use, for an example, your card if you look at your bill, and let's just say that your APR, your annual rate, is 20%. You would take that 20% and divide it by 365, and you would come up with your daily rate of 0.0547%. So interest rate on credit cards generally is charged on any balance that aren't paid by the due date of every month. So when you carry a balance from month to month, interest accrues on a daily basis. That's your DPR. So you have to remember this daily periodic rate, and the DPR is just another way of saying that whatever your APR is, you divide it by 365. All right, that's fine. So if your APR is 20% and your DPR is 0.0547%, you're getting charged that 0.0547% every day. So in this case, the interest rate on this is 29.99%. So my DPR, or the DPR on this application, would be 0.0821%. So you can see the difference in a 20% interest rate and a 29.99% interest rate is 0.0547 and a 0.0821. So it's a big difference. And the reason why credit card balances grow so quickly is because credit cards with high APRs, like this one, compound the interest on a daily basis. So let's look at that again. If you have, and as I said earlier, 78% of Americans are living paycheck to paycheck because of bills like this, you're getting charged interest every day. So whatever balance you have, they're going to charge that point, in this case for this credit card, 0.0821%, and add that to your balance. And then the next day, they're going to take that balance and times it by 0.0821 and add it. So every day you're getting charged interest on the day before's interest on the day before's interest that's on your balance. So in this case, if this was a $4,000 balance, do the math and it adds up. So it's, people ask me when I'm in meetings, why are credit cards so expensive? Well, they're charging so much interest. On this card, so if you read these things, it says, where was it? They calculate their daily, all right, so they calculate the rates by adding a percentage to the prime rate. And as I had said earlier, how I'll talk about prime rate in a moment, they're using the prime rate at 8.5%. So on top of a prime rate, they're adding a 21.49%. So pretty much 21.5% interest on top of the prime rate to come up with a 29.99% interest rate. So the reason why credit card balances can quickly build up is that they are charging interest on top of interest for 30 days. So at the end of each day, credit card interest rates get calculated and added to your balance for the next day. This continues each day or every day for that billing period. So the interest that you're charged on one day becomes part of the balance the next day. And this is something that we work on to eliminate credit card debt. There's no reason to have it. You don't need to live by your credit cards. And charging, in this case, 29.99% interest, I understand why so many people are living paycheck to paycheck. So this information, again, is from Chase. I just went out on Google and typed in, interest rate on credit cards and so on. But then I also have clients who ask these type of questions, and this question came up and it said, do you charge interest if you're paying the minimum? And Chase, the answer is yes. If you pay the minimum payments on your credit card statement, you're still getting charged interest. By paying the minimum, you keep your account in good standing, but you do not avoid accruing interest. Credit card companies want you to pay the minimum because they're making the money from interest that based on the balance of the credit card that you owe them. So the exception to this is those introductory offers of 0% for whatever it is, 1 month, 2 months, 5 months, 10 months. But usually they set a period, of time for those introductory zero interest rates. And then after that, you get bumped back up, in this case, to 29.99% interest. So, yes, you are going to get charged interest if you don't pay the balance off in that time frame. So, and then another question is, how is the prime rate determined? And as mentioned, the prime rate is set by banks and by lenders. In this case, the Federal Reserve sets the prime rate, but so does JP Morgan. So for example, the Fed sets the rates, and in this case, I'm just going to use an example that of, let's say, 4%. And usually the bank or lending institution will add an additional 3% on top of that. So if you're, in this example, if the Fed sets a rate at 4 and the bank adds another 3, then the prime rate for this example would be 7. And therefore your annual APR, your annual periodic rate, is based off of that. On this, they're adding another 21.5% interest to that prime rate. So it also pertains to your credit history, your credit score, your income, and so on. So before I did this video, I went out and I checked the JP Morgan prime rate for today, the 19th, and it's at 8%. So think about this and the example. Their interest rate is 8, so therefore it's at 3% on top of that. The prime rate would be 11, and in reference to this introductory offer, they would add 21.5% interest on top of that. So there you're at your 30%. Every month, the rate is recalculated either in the Wall Street Journal or by JP Morgan. So that is a variable rate that could go up or down every month. So that's something to think about. So I got this information from NerdWallet, and it's how to figure the minimum amount that's due on the credit card every month. And so the way that credit card companies normally figure this out is they take, on average, a 5% of the balance, and that is your your minimum due. So the credit card minimum amount due is the amount that the cardholder is required to pay on or before the due date. And so if you have a $4,000 balance, like this, 5% of 4,000 is $200. But then also you're going to have your DPR, your daily rate, daily interest rate, as well as any fees, any late fees, the fees here are unreal. Monthly fees, transaction fees, late fees, return payment fees, it can add up very quickly. And on top of those fees, they're going to hit you with more interest. So remember that when you receive these applications in the mail, rip them up and throw them away. It's better to work on getting rid of your debt than accruing more debt, because you'll never, ever get out of debt with more credit cards. So pay down your credit cards. Do whatever you have to do to get out of debt. So again, if you have a moment, if you like what I'm talking about today, please follow us and like us on this website, like us on this page. Forward this out to friends or family who may be in debt or have issues with credit cards. I'll be more than happy to help them any way that I can. Our website is www.debtfreeresults.com. I invite you to come over to visit our site, and if you want to schedule a free consultation session, just fill out the application and we'll get you on the books to sit down and talk about how my services can help you in reference to getting out of debt. I know that you can do this. I've seen it in my clients every day. I know that I can help you in any way that you need in reference to attacking credit card debt, car payments, or whatever. So stay focused on your debt-free journey. If there's anything I can help you with, please reach out. God bless and have a great day. Thank you.